Hello, I'm David Frazier, the President and Chief Market Strategist of Frazier Mayo Research, LLC. Also doing business as Investors Monitor and investorsmonitor.com. And of course, the editor of Frazier Strategic Allocator. In this week's internet TV show, which I'm recording at around 10:30 in the evening on Thursday, February the 16th. You got it around 10:30 in the evening. It's been a long day. That's okay. I love what I do. I love the challenge, and I truly, very sincerely love trying to help other people in numerous ways in life, but and this is in regard to this service, of course, and helping you to avoid the big downturns in the financial markets and to profit from the major upturns and to essentially make money in the financial markets without taking undue risk. And well, I think I've done a good job at that thus far since the relaunch of our Frazier Strategic Allocator Individual Investor Service. And I have a track record that indicates that I've done a good job with that over at least about the past 10 years now. But anyway, enough about that. Hopefully, you've already realized in my past videos and my writings, whether it's our weekly commentary or our monthly investment journal or our trade alerts, I'm not one of these persons that tries to hype up things and makes it sound like we're just doing an outstanding job and we're always making fantastic recommendations. It's not my style. And I'm also not one of these gloom and doom guys who always tries to scare people into paying for their services because that person's supposedly going to warn them about some doomsday event. I'm a straight shooter. I stick to the facts without trying to hype up anything, and I focus as much and probably sometimes more on managing risk, that is in trying to prevent losses for our clients and subscribers, as I do on trying to make money for our clients. And the reason being is really simple, and that is my experience has shown over more than 25 years, around 30 years now, of investing, trading, and speculating in the financial markets, that if one minimizes their losses on a portfolio basis, you're always going to have some big losses. They're never pleasant, but they're going to happen. But if we even try to minimize all of our losses, but definitely on a portfolio basis, and avoid the big downturns in the financial markets, hey, we're going to be way ahead of the game because it's not terribly difficult making money in up markets. Enough about that too. In this week's video, even though it has been a long day, I'm a bit tired, I'm a little pumped up. I just got home, not that you care, but from one of my karate classes that I go to every week, and so even though it's late in the evening, I still have energy. And so this week's show, what I'm going to talk about briefly, because I'm trying to keep these shows shorter than what they've been at times in the past, where at times in the past they were way too long and they just got boring and were more like a classroom rather than just telling you what you need to know. And I do want to educate our clients, but I don't want to bore you. I don't want to overhype and get too excited. This is not a game. I don't believe in playing in the market, but at the same time, we don't need these shows to be boring. So we'll try to keep it brief and get right into this week's topic, which is stock market valuations. I mean, good gosh, the number of persons that I've heard claim over the past several months that U.S. stock prices are supposedly greatly overvalued, substantially overvalued, and are due for a big decline. Well, the facts just don't support those claims. Now, without exception, every person thus far that I've heard comment on these supposedly high valuations has always referred to only one variable that determines valuations, and that is the price to earnings ratio. And because most of these folks tend to talk about the overall stock market is measured by the major stock market indices, and primarily the S&P 500 index, they focus on the PE ratio for the S&P 500, and they've claimed over many months now that the PE ratio is way high. Stocks are way overvalued. Well, there are other factors that determine a company's and stock's value other than just the PE ratio. But first, let's talk about the PE ratio a bit. Well, currently the PE ratio, based on the quarterly earnings results of U.S. publicly traded companies for the quarter ended September 30th of 2016, as well as on earnings that have been released thus far by companies for the quarter ended December 31st, 2016. The current PE ratio as of today, boy, I am tired. I can't think. What day is it? As of today, Thursday, February 16th, it's right around 26. Well, that's not a terribly high value. I mean, here's some facts. I'm going to read from some notes that I took earlier today. That PE ratio, 26 for the S&P 500, as of today, February the 16th, is lower than it was during any month from March 1998 to December 1999, a period during which the S&P 500 Total Return Index, that's the S&P 500 index including dividends, appreciated by 37% during that period. When the PE ratio was right around the same level that it is currently. And, actually the PE ratio right now is a bit lower. I think it was in around 28 to 29, or even got up to 30 during most of those months from March 1998 to 1999. So it's currently lower than it was during that period, or during every month in that period when the S&P 500 Total Return Index appreciated by 27%. It's appreciated by 37%. It's also currently lower than in any month from October 2002 to August of 2003, when the S&P 500 Total Return Index appreciated by 26%. I'm going to go on. I'm going to give you a few more examples. In fact, the PE ratio for the S&P 500 is currently near the same level that it was during January of 1992, at around 26, after which the S&P 500, including dividends, appreciated by 260% from January of 1992 to the end of the 1990s. And lastly, let's see, during March of 2002, the PE ratio got all the way up to 46.7. And what happened after that period, when stocks were once again, way back then, supposedly way overvalued? Well, the S&P 500 Total Return Index appreciated by 59% from March 2002 through October of 2007. So there's just no justification based on historic levels for the PE ratio for the S&P 500 to claim that stock prices in general are overvalued. Now, there's numerous individual stocks that I would argue financial market participants are substantially overvalued. And I have not recommended any of those securities to you, even though I like what I see a lot in the underlying companies of those stocks. We don't want to go in and buy stocks at what appear to be inflated prices. But based on historical levels for the P ratio for the S&P 500, there's no justification to claim that stock prices in general, as measured by the S&P 500, are overvalued. In fact, there are numerous factors that suggests that, ironically, financial market participants are probably undervaluing stocks in general. Let's see. So, of course the PE ratio is currently at somewhat of a higher level than what's been during many periods in the past. But there's a very important factor to note here, and that is the PE ratio has always risen to somewhat high levels as compared to others levels, which it's been in the past. It's always risen to somewhat high level during periods after corporate earnings decline for a quarter row. That's exactly what happened during the past year, at least, when the after-tax profits of U.S. companies in aggregate declined 13.3% from December 2014 to June 2016. It declined 13.3%. So the ratio started right as people didn't sell for stocks on the Instagram long-term and the PE therefore corporate profits declined. Now, all corporate profits rebounded some during the quarter of last year to also amount settlers that are December 2014. So, I want to get deep this. I am letting know I'm talking about this on one of these. But to get patient, have this odds range or profits or declining the plots. But we look at the course of a year profile and how as if they begin to line that it recovered the pace of 6 quarters, I think it was, at least a quarter out, trying to make their run. And based on that starting handcuff, I've viewed of at least the fourth quarter 2016 earnings results. It's pretty clear to me that corporate profits in aggregate are continuing to rebound, and therefore what you're going to see is a supposedly high PE ratio, prices divided by earnings. If earnings are rising more on a percentage basis than stock prices are rising, well, the PE ratio is going to come down. Okay, let's see. Now, another important factor. Well, astute stock market investors, traders, and speculators, they don't value stocks based on what's happened in the past. They don't value stocks based on prior earnings. But that's exactly what the price to earnings ratio does. It takes the current price of a stock or stock market index and it compares it to the earnings of the underlying companies over the prior 4 quarters. It's looking at prices based on past earnings. Astute financial market participants value stocks based on their expectations for the future earnings and future direction of earnings. And there's numerous factors to suggest that corporate profits are going to continue to rise over at least the next 12 to 18 months. Next, there's numerous factors. Once again, I don't want to make this too long. There's maybe I'll write about this or I'll send you the notes that I've put together. And so I don't want to make this video too long. There's just numerous factors that suggest that the sales revenues the companies generate are going to continue to rise. There are companies in the aggregate are going to be able to charge higher prices for the goods and services because of the improving economy and the improving employment situation. At the same time, productivity is rising. For 2 quarters in a row, productivity has risen considerably, yet unit labor costs have, at least the rate of increase in unit labor costs have declined. Why is that important? Well, labor costs account for the greatest percentage or portion of most companies' expenses. So if you have productivity rising, the prices are rising, companies are selling more products and services, but they're maintaining or reducing their expenses, well, profits are computed by subtracting expenses from revenues. Next, what tax rates, cuts in tax rates. I mean, I think, in my opinion, it's an almost certainty that by the end of this year, we're going to see the U.S. Congress substantially reduce U.S. corporate tax rates from, if they go by Trump's proposals, from the current statutory rate of 35% way down to 15%. Well, what's that going to do for corporate profits, the after-tax profits? My gosh, if you take a company that was paying the statutory rate of 35%, and let's say it had $100 in profits before taxes, well, after taxes, you of course have $65 in profits. But what happens if the corporate tax rate is cut from 35% to 15%? Well, those corporate after-tax profits are going to be substantially higher than they were before the tax cuts. And then lastly, I've yet to hear anyone that claims that stock prices are overvalued talk about the tremendous appreciation in the net asset value, the book value. That is assets minus liabilities of any given U.S. company. The net worth, the net asset value, the book value of companies' assets rose 67%, I think it was, over from the third quarter of 2009 to the third quarter of 2016. The net book value, the net asset value of U.S. corporations in the aggregate rose by 67%. Well, don't we also want to base the value of a company and its stock on its assets? Not just on what amount of money it's going to make in the future, but the current value of its assets. And if the current value of its assets have risen substantially, well, obviously the company's stock is worth more. And that doesn't even take into account the fact that the market value, the resale value of corporate assets, I don't know the number, but it's probably at least doubled during that same period that I mentioned. From, what was it? I'll look again. From the third quarter of 2009 to the third quarter of 2016. I mean, if the book value, I don't know if all of you know how book value is computed. The book value is based on the prices that the company pays for its assets, but that doesn't mean that's the current value. The current value is its resale value. Well, I would argue that the resale value of corporate assets in the aggregate here in the United States have probably at least doubled during that same period. So there's just no justification to claim. There's no justification behind the claims by a lot of so-called experts. The U.S. stock prices, in general, are substantially overvalued. No justification. Now, does that mean that stocks are going to go straight up from here? Of course not. We're going to have pullbacks. And right now, I mean, I'm thinking we're probably going to get a pullback any day now, and probably potentially for several days, just because of the way that stocks have continually moved higher with the almost slowdown over the past couple of weeks. But, this is not a short-term trading source. And what if I'm wrong? What if they don't pull back? What if they keep moving higher? And I tell you to sell something that I think, that is any of our securities that I think are going to be appreciate substantially more higher than their current levels over the next 12 to 18 months. So I think I'm going to wrap up there. I'm sure we're at least 20 minutes into this. It seems like all then. And, I thank you for listening and watching. I hope you got something out of this. As always, don't hesitate to send us an email if you have anything that you'd like for us to discuss regarding the benchmarks. Thank you. I'll speak again next week.